Welcome to IAS Project. We are continuing with the videos on Indian economy for UPSC Civil Services Exam. Now, as we have said, the gross value added can be calculated at different prices and costs. So let us understand what is cost and what is price. First, let us look into what is a cost. Cost is nothing but the expense incurred for creating a product or a service. So in a production process, a cost simply means whatever is the money that goes into making the product or manufacturing the product or a service. It includes expenditure on various inputs. Inputs are nothing but resources or factors of production. We know that there are 4 factors of production: land, labor, capital, and enterprise or entrepreneurship. So, cost includes expenditure on various inputs like rent for land, wages for labor, interest for capital, and profits for entrepreneur. So, all these together is called as a cost. Then what is price? Price is an amount at which seller or buyer are willing to sell or buy a product or service. So, price is nothing but a willing amount at which the buyer or seller wants to buy or sell a goods or service. So the difference between cost and price is that cost is an expense incurred, while price is the amount at which seller or buyer are willing to buy. Difference between price and cost is usually called as a profit. So let's talk more about cost. Since cost is the expense which is incurred on the factors of production, it is also called as factor cost. So as we have seen, factor cost is nothing but expense incurred on factors of production, and that expense is incurred because we want to convert raw material or a resource or an input into a product or a service. So factor cost includes rent towards land and expenses towards raw materials. We know that raw materials also are considered as a part of land. For example, water, minerals and metals, etc. are considered a part of land as long as we talk about factors of production. So expense towards raw materials as well as rent towards land or building is considered a part of factor cost. Also, wages or salaries towards labor, interest towards capital, as well as depreciation. Depreciation is nothing but the loss of value of an asset. We will look into what depreciation is in the further slides. Also, profits towards enterprise or entrepreneur is included within the factor cost. So factor cost mainly includes 4 aspects, that is rent, wages, interest, and profits. Let's look at what depreciation is. Depreciation is nothing but decrease in the fair value of an asset. And such decrease in fair value occurs over a period of time. Why does this decrease occur? Because mainly of wear and tear that occur with the usage of machines. So over time, the fair value decreases, and this decrease is called as depreciation. In the terms of economy, depreciation is often called as consumption of fixed capital. There is a small difference, however, between depreciation and consumption of fixed capital. Consumption of fixed capital is preferred to depreciation. Let's look at more into factor cost. Factor cost can be given by the formula here. Factor cost is nothing but CE plus OS or MI plus CFC. CE stands for compensation to employees. Compensation to employees is nothing but the wages or salaries that are given to the labor. The wages or salaries, it must be remembered, can be given either in cash or in kind. For example, a professional who is working in an urban area, for example, in a firm like a car manufacturer or mobile manufacturer, is paid in cash or directly a transfer to his bank account. However, for example, a landless laborer who is working in a farmer's field is usually not paid in money, but usually paid in the produce which is produced on the field. For example, food grains. So he is given food grains for the work he is providing or the labor he is providing. So compensation to employees includes both cash as well as kind, wages and salaries. The third term here is CFC. CFC means consumption of fixed capital, which is also nothing but depreciation. We have already seen the meaning of depreciation in the last slide. That is, depreciation is nothing but a decrease in the fair value of asset. We must note that all capital assets depreciate over time. For example, there is a company called XYZ and it has bought a new car. Let us say the cost of the car is 1 crore. In the first year, the value of the car decreases by 45%. And this 45% is called as depreciation. So 45% means 45 lakhs. So 45 lakhs is the depreciation of the car in the first year. So the fair value of the car is nothing but 55 lakhs in the first year. In the second year also, it further depreciates. So if we see, depreciation in the first year is nothing but 45 lakhs. Consumption of fixed capital is calculated in a slightly different manner, that consumption of fixed capital is whatever is the initial value minus whatever is the new value. So instead of directly saying the depreciation is 45%, we say that consumption of fixed capital is 1 crore minus 55 lakhs, which is 45 lakhs. So instead of using the percentage to calculate consumption of fixed capital, we remove whatever is the new value from the initial value and we get consumption of fixed capital. However, we must note that both yield the same value. Depreciation is also 45 lakhs and consumption of fixed capital in the first year is also 45 lakhs. So the second term is operating surplus or mixed income. Operating surplus or mixed income is nothing but the surplus accruing from the processes of production after deducting all the remaining expenses. So for example, there is a company called XYZ again, and the company XYZ has paid compensation to employees, and it has also factored for consumption of fixed capital, and now it has also paid for interest for the capital, rent for the land, and other charges like electricity, water, etc., etc. And then the remaining income is called as operating surplus of the company. It is called mixed income in case of unincorporated companies. It is called operating surplus in case of incorporated companies. So the terminology is different, but what they mean is same. So factor cost is nothing but compensation to employees plus operating surplus or mixed income plus consumption of fixed capital. Let's look at what operating surplus or mixed income is. First, let's see what is the case of incorporated companies. In the case of incorporated companies, it is called as operating surplus. Let's look at what incorporated companies are actually. Incorporated enterprises are nothing but those enterprises which are established as a separate legal entity. Separate legal entity meaning the owner is not the company here. Company itself is a new entity and the owner himself is another entity. Such incorporated enterprises can enter into contracts and can be sued in court for breaching those contracts irrespective or without involving the owner, because owner is an entirely different entity from the company. Examples of incorporated company, the best example is limited liability partnership. We will study all these in further videos. In the case of unincorporated companies or unincorporated enterprises, it is called as mixed income. Let's see what unincorporated enterprises are. They are not established as a separate legal entity. Here, owner simply means the enterprise. So if someone is suing enterprise, it simply means that he is suing the owner in a court. If owner is entering into an agreement, it means that enterprise is entering into an agreement. So there is no distinction between the owner or investor and the entity or the enterprise itself. Also, the enterprise itself cannot borrow or enter into any contracts on their own. Owner in place of the enterprise borrows and he also enters into contracts with other entities. So everything is done in the name of the owner and by the owner or investor. Examples of unincorporated enterprises are proprietorship concerns as well as partnership firms. As unincorporated enterprises are owned by households, so what happens in unincorporated enterprises is that in most of the unincorporated enterprises, there are two kinds of labor being provided to it. One is from employees or outside employees who get salary or a wage. Also, there are members from within the household who are working for the enterprise. They are giving their labor, but they are not receiving salary. They are not receiving salary. So what happens is, after paying to these employees and after accounting for consumption of fixed capital, whatever is the remaining surplus is there, that surplus is taken over or taken by the owner and his family household. So once it is taken by the household, they may internally distribute the salary. This does not fall into the affairs of the company or enterprise itself. So as the operating surplus also includes the salary of household members, it is not just called as operating surplus, but it is called as mixed income because it comprises of surplus as well as salary. So in the unincorporated enterprises, operating surplus consists of both operating surplus as well as salary for the household members. That is why it is called as mixed income. Mixed income therefore means surplus plus salaries. So let's look at the definition again. As unincorporated enterprises are owned by households, members are not paid in salaries separately. Although the household contributes to unpaid labor inputs similar to paid employees. As the surplus also contains salary of household contributors, it is called as mixed income. We have seen what factor cost is. Now let's look at what basic prices are. Basic prices are also called as producer's prices. Basic prices are equal to the production cost. When we add production taxes less production subsidies to the factor cost, we get basic prices. So let's look at what happens in a production. In a production, resources are transformed into goods and services. So resources are transformed into goods and services because certain inputs are made by factors of production. And these factors of production get some return or get some payment, which is called as factor cost. However, this factor cost does not include payments to governments. For example, government may introduce or impose production tax because you are producing goods and services. Also, it may give you a benefit in the form of subsidies, which are also called as production subsidies, because you are producing such kind of goods where subsidies are applicable. So as production tax and production subsidies are not accounted for in the factor cost, we can introduce them now. So if you add factor cost and production taxes as well as adjust for production subsidies, because production subsidies are basically an income, not an expenditure, we have taken it in the negative side. Production taxes minus production subsidies are sometimes called as net production taxes. So net production taxes simply means production taxes minus production subsidies. These are usually imposed by government. So basic prices are nothing but factor cost plus production taxes minus production subsidies. We know that within the factor cost, we have compensation to employees, consumption of fixed capital, and operating surplus or mixed income. So factor cost is basically these three things. So if we add production taxes and production subsidies to this, we will get a formula like this. Basic prices are nothing but this term, these three terms represent factor cost, and we have production taxes minus production subsidies. Let's look a bit further into production taxes and production subsidies. Production subsidies are imposed irrespective of quantity of production. Examples of production taxes include license fees, land tax, stamps and registration fees, professional tax and other taxes. Also, they do not depend on the volume of production. For example, let's say you have opened an enterprise. In the enterprise, you want to manufacture water bottles. If you want to manufacture water bottles, you have to take certain kind of permissions from the government. Those permissions come with certain fees like license fees, land tax, stamps and registration fees and other taxes. These taxes are called as production taxes. For example, after opening the company, you may decide you are not going to make any water bottles. You are not going to make anything at all. Even then, you have to pay production taxes as long as the enterprise is in operation. So as long as you do not close the business, you have to pay production taxes even though you are not producing a single water bottle. Also, if you produce 100 bottles or 1000 bottles or million water bottles, the production tax is not going to change. So this is about production taxes. Similarly, production subsidies also are subsidies that are not dependent on the volume of production. They do not depend on how much water bottles you are producing. Example of production subsidies include input subsidies to farmers. For example, we know related to water, electricity, subsidized loans, and other aspects, farmers get production subsidies. These water, electricity, subsidized loans are mostly not related to the quantum of production. Similarly, subsidies to railway by government, subsidies to village and small industries are also examples of production subsidies. Let's follow in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.